Hey everyone, welcome back to the channel. Today we're diving into an important topic that many people overlook, the financial realities of retirement. You might think retirement's supposed to be cheaper, right? No commute, no office wardrobe, no more saving in retirement. But for many retirees, expenses don't go down, they just shift. In fact, some of your biggest costs might not go away at all. In this video, I'm going to break down 5 hidden or overlooked expenses that can quietly drain your retirement income, plus what you could do about them. But first, let's look at a little history. For a long time, the American dream was pretty straightforward. Work hard, raise a family, pay off the house, and retire knowing that your biggest financial worries were behind you. And for a lot of people, up until about the 50s or 60s, that was actually the reality. The mortgage was gone, the pension was paid reliably, and Social Security covered the basics. But in the 80s, pensions started to decline as the 401k emerged as the new retirement plan. The early 2000s brought on a surge in healthcare and housing expenses, and since then, people have started living longer and kids have stayed on the parents' payroll until a later age. All that to say, things look a little bit different than the original American dream. Let's talk about how today's retirees are facing some of their biggest financial challenges after that final paycheck stops. The first cost that I want to talk about is healthcare. Now, the illusion that healthcare in retirement is free in the United States is just that. It's an illusion. Medicare is going to have some out-of-pocket expenses. You're going to have to pay for Medicare Part B and Part D premiums, and sometimes Medicare supplemental policy, or sometimes referred to as a Medigap policy, to extend your coverage and also help limit some of your deductible and copay expenses. Also, make sure to work with a Medicare professional when you go to pick out these expenses because they can price out your Medicare supplemental plan. So you're going to have other healthcare expenses in retirement that you might not have planned for. It's possible that a married couple could pay over $300,000 during their lifetime just in healthcare costs in retirement. And then you've got these funky things called IRMAA surcharges, or income-related monthly adjustment amount, that you have to deal with in retirement. This affects your Medicare premiums if you make over a certain amount. So it's important to keep an eye on your income if you're in retirement. For some people, it's impossible to avoid altogether, but you could be mindful of it and sometimes maybe not jump yourself into the next bracket, because these brackets are like cliffs. And once you go $1 into the next bracket, you're going to pay the whole Medicare surcharge in the year that it applies. Now, another thing that you could do to minimize your healthcare costs in retirement is that you could look into maximizing your HSA or your health savings account. These can be carried into retirement and they go in pre-tax today. They can grow tax-free if your plan allows for investing that balance once it reaches a certain amount. And it comes out tax-free for healthcare expenses in retirement. Many of our clients that have funded this type of account before retirement feel much better about their healthcare expenses in retirement. While Medigap policies typically allow you to see your preferred doctors, Medicare Advantage plans may have limitations on coverage for certain out-of-network doctors. So you want to make sure that your preferred doctors are covered if you select this type of plan. The next cost I want to cover with you is housing. A lot of people try to pay off their mortgage before they reach retirement because that's what Dave Ramsey said. I don't agree with Dave Ramsey completely in all situations, and I think that every situation should be looked at individually according to your specific financial plan. However, if you have paid off your mortgage, you're not out of the woods yet. You've got home maintenance costs, upkeep, repairs, and according to Home Guide, this could be around 2 to 2.5% of the home value. So let's be conservative for a moment and just run through an example. Assuming we have a house valued at $750,000 and the home maintenance, repairs, and upkeep is 2%, that would be about $15,000. So we've got $15,000 worth of maintenance, upkeep, and repairs, and that does not include taxes and insurance. If we assume taxes are conservatively around 0.5% of the home value, it could be much higher depending on the market, but that comes to about $3,750. Insurance would run around $5,000, and utilities can add another $5,000 when you factor in electricity, gas, water, garbage, internet, and cable. And when you combine it all, you're looking at $28,750 in just expenses, and that's before you even wake up in the morning. This is before you buy your groceries or go on any trips. And for many people, that's your whole Social Security paycheck. So just going toward maintaining your home. So it's something to keep in mind when you're going into retirement, and it's something to factor when you're putting together your financial plan. Not only will you have these expenses, but they should also be adjusted for inflation in your projections. Now, taxes are the next expense that just don't go away. various sources of retirement income can push you into unnecessary tax brackets. And there's certain planning strategies that you can do leading up to retirement, specifically before the age of required minimum distribution. So if you've retired before the age of 73 or 75, you still have some room to implement some of these strategies, and they can mitigate your overall tax liability in retirement. So if you have a pension, Social Security, and required minimum distributions, if you do nothing today, these could put you into a tax situation that you might not feel completely comfortable with. If that's the case, it could also bump you into those IRMAA surcharge brackets. If you don't take steps today through Roth conversions or early withdrawals from your IRA, it could bump you into a higher tax bracket in the future and trigger those IRMAA surcharges. The next expense that is often unplanned is family support. This includes helping children, potentially aging parents, and providing for grandchildren. When we have financial planning discussions with clients, they often express that they feel they've already provided substantial support through education and believe that their children are now independent. However, life can bring unexpected challenges, and many parents find themselves stepping in to help children when they face financial difficulties. If this support occurs occasionally, it may not significantly impact your plan. However, if it happens consistently, such as $20,000 a year for 25 years in a row, helping multiple adult children, the total could reach $500,000. Depending on your current net worth, future plans, and spending goals, it's important to consider this support in your financial planning. Many times, these goals aren't unattainable if they're properly planned for, but if providing assistance to family is a priority, it's important to incorporate it into your financial strategy without compromising your own needs. And sometimes this might mean working a couple extra years or adjusting other financial commitments that might be a lower priority. According to Thrivent in 2025, 50% of parents reported at least one adult children, the ages between 18 and 35, moving back in with them after living independently for some period. So the other advice is potentially having to set some boundaries, which isn't always easy, but sometimes necessary, allow you to enjoy the retirement that you've worked so hard for and planned for your entire life. The last hidden cost to discuss is lifestyle inflation. This is different from lifestyle creep. Lifestyle creep happens in your 40s and 50s when you start making a bit more money and begin spending more, getting those subscription services that you forgot about, but they're still hitting your credit card until you do an audit. Lifestyle inflation happens when newfound free time in retirement leads to increased spending. This could be in the form of dining out, new hobbies, home renovations, or a little extra travel. From a financial planning standpoint, if you know you want to spend more in those early retirement years, plan for those elevated expenses. Some clients say they want to travel more during their go-go years. They want to travel everywhere and not let their feet touch the ground. If that's the case, let's plan for it and see if it works, so you're not blindsided when that need arises. So all of these costs don't make retirement impossible, but they do make planning more important than ever. If you've enjoyed this video, please go ahead and like and subscribe below and be on the lookout for more videos about how to get the most out of life in retirement. Thanks for watching.